I've seen more people ruin $1 million than protect a quarter of it. That's not just some clever phrase to grab your attention. That's 30 years of watching grown adults panic, overreach, and fumble their future because they thought they needed to play catch up. They had the raw capital, they had the time, but they didn't have the temperament. Let me tell you something hard. It's not about how much you have, it's about how well you use what you have. I'd take a disciplined person with $250,000 over a gambler with $1 million any day of the week. And here's the kicker. Most people don't want to hear that they want the shortcut, the jackpot, the magic stock that quadruples overnight. But wealth, real, lasting wealth, doesn't care what you want. It rewards behavior, not fantasy. So if you're sitting there thinking, I don't have enough, I need to swing big, you're already halfway to losing. Let's be honest. If you're over 45, maybe 50, and just now starting to take your finances seriously, you don't get to press reset anymore. This is the stage where mistakes get expensive. You don't have decades to rebound. You don't get to learn by failing fast like some startup founder in his 20s. Every decision you make from here on out compounds in the right direction or the wrong one. And I don't say that to scare you. I say it to snap you out of the illusion that you've got all the time in the world to mess around. You don't. But here's the good news. You don't need $1 million. You don't need to hit home runs. You don't need to chase every shiny opportunity. You need to stop leaking money through stupidity. You need to stop outsourcing your judgment to hype and headlines. And most of all, you need to stop telling yourself you're too late, because you're not. You just need a better playbook, one that protects the downside, compounds the upside, and lets time do the heavy lifting instead of ego. So if you're sitting on $250,000 or even $100,000, don't disrespect it. It's not too little. It's not too late. It's just waiting for you to treat it like it matters. And if you can do that, if you can get your behavior in line, that smaller pile will quietly outperform the fools chasing 10 times returns with $1 million and a gambler's brain. I remember a guy, let's call him Mark, smart, educated, late 40s, came into money after a buyout, walked away with just under $1 million. But here's the thing about Mark. He thought he had to make up for lost time. He didn't want to just be secure. He wanted to be rich, fast. So what did he do? He fell for every flashy pitch out there, pre-IPO crypto deals, tech startups with glossy pitch decks, high-yield passive income scams, you name it. He didn't ask the right questions. He didn't build a margin of safety. He didn't even really understand the things he was buying. He just wanted them to work, and within 5 years, gone, all of it. He went from a millionaire on paper to refinancing his home and borrowing against his 401k just to stay afloat. You know what hurt the most? It wasn't the money. It was the regret, the shame, the gut-wrenching realization that he had the capital and blew it trying to be clever. Now contrast that with someone else I know. Linda widowed at 55, inherited $250,000. She was terrified. She had no financial background, no MBA, no slick strategy, but she had one thing going for her. Humility. She didn't try to double her money overnight. She learned basic value investing. She stuck with boring, high-quality companies. She lived below her means, and she let time work. 15 years later, she's in a better spot than Mark ever was. Not just financially, but mentally. She sleeps at night. She trusts her process, and her portfolio is still growing. You tell me who won, because it sure wasn't the guy with more zeros. Let me walk you through the common diseases that infect people with capital but no judgment. These are the sins that turn opportunity into regret. This is the most suicidal move I see. People treating their retirement portfolio like a roulette table. They think, I only have a couple $100,000. That's not enough. I need to 10 times this. So they pile into speculative bets, crypto, biotech, penny stocks, pre-revenue startups, meme trades. And here's the punchline. They don't even understand what they're buying. They're outsourcing their future to something they read on Reddit, saw on YouTube, or heard from their cousin's friend's trading group. This isn't investing. This is a last-ditch lottery ticket dressed up in jargon. You don't swing for the fences with capital you can't afford to lose. You protect the base. You survive. You stay in the game. Fools forget that. Winners never do. overcomplicating everything. There's this seductive lie that the more complex your strategy, the smarter you are. So people end up with 15 brokerage accounts, 9 asset classes, options trades they don't fully grasp, real estate syndicates they can't monitor, and newsletters from 12 gurus telling them 12 different things. Complexity is the enemy of execution. If you can't explain your portfolio to a 10-year-old, you probably don't understand it yourself. And when things get volatile, which they will, you'll panic because you never had clarity to begin with. Keep it simple, keep it boring, and watch how that boring simplicity compounds while others self-destruct trying to be clever. Confusing movement with progress, checking your account daily, constantly tweaking, chasing headlines, rotating into the next hot sector, all under the illusion of being active and engaged. Let me tell you something. Most of the time, the best move is to sit on your hands. You don't get rich fiddling. You get rich holding. You don't get rich reacting. You get rich by preparing before the chaos. Most people panic sell at bottoms, buy at peaks, and justify it with some garbage narrative about protecting downside. What they're really doing is giving their emotions full control, and that's a tax you can't afford. Falling for fake sophistication. There's a whole cottage industry built around making people feel smart while draining their capital. High-fee hedge funds, shiny trading platforms, private placement deals, alternative investments sold with 60-page slide decks. It all sounds advanced, but when you strip away the polish, you're paying too much for too little, with too much risk. Sophistication doesn't come from looking complex. It comes from knowing what to ignore. You want sophisticated? Try holding a few high-quality assets for 30 years without flinching. That's real intelligence, the kind that doesn't advertise itself. Telling themselves they're too late, so might as well go big. This one's emotional. It doesn't show up in spreadsheets, but it's the root of so many implosions. People feel behind they didn't invest early. They wasted time. So now they think the only way out is a miracle play. They say, I've only got $250,000. What's the point of being conservative? The point, my friend, is that $250,000 done right can become $700,000, $1 million, more. If you stop bleeding it with dumb bets, but if you blow it trying to be dramatic, it won't come back. Time won't give you another round, and no one will feel sorry for you, especially the market. So stop trying to be the comeback kid. Be the person who stops making it worse. One core rule: never risk what you can't rebuild. That's it. That's the whole game. I don't care how smart you think you are. I don't care how confident you feel in the moment. If you're putting capital at risk that you cannot afford to lose. Capital that, if gone, would force you to start over in your 50s, 60s, or later. Then you are gambling, not investing. And that mindset, it's the reason most people lose. Let me unpack why this rule matters more than ever, especially if you're not in your 20s anymore. Say you have $250,000. If you earn a realistic, steady 6 to 7% return over the next 20 years, that becomes over $900,000. No miracles, no rocket ships, just basic compounding quietly working while you sleep. But here's the catch. That only works if you don't lose it first. Lose 50% in one bad year because you chased a moonshot or fell for a scheme. And now you need a 100% gain just to get back to even. That's not strategy, that's stupidity. When people feel behind, they start making decisions from fear. I need to catch up. I can't retire unless I double this. This is my only shot. That desperation clouds judgment. They stop asking, is this smart? And start asking, what if it works? Big difference. Never risk what you can't rebuild forces you to get honest about your margin of safety. It forces you to think long-term, not emotionally. It keeps you from putting yourself in a position where one mistake erases 20 years of work. I've said it before. Wealth is built on not losing. The best investors are obsessed with downside protection. They focus on survival. They move slowly, methodically. They don't need to win every year. They just refuse to blow up, because if you avoid catastrophe long enough, compounding does the heavy lifting for you. But if you break the compounding engine, if you interrupt the process with reckless behavior, it's over. Time doesn't forgive. So here's the core rule again. Never risk what you can't rebuild. That doesn't mean you never take risk. It means you calculate risk with brutal honesty. Ask yourself, if this goes to zero, can I still sleep at night? If this doesn't work, can I recover? Am I doing this because it's smart or because I'm afraid? If you can't answer with clarity, you're not investing. You're playing with fire, and the older you get, the drier the timber, the more permanent the burn. What to do if you're holding $250,000 and don't want to screw it up? If you're over 50, your main job is not to grow fast. Your job is to protect principal and let time plus discipline grow it slow and safe. Every dollar you lose now costs more than it did 20 years ago because your runway is shorter. Adopt a new mindset. Capital is sacred. Behavior is leverage. If you can't explain it on a napkin, don't buy it. It doesn't matter how trendy it sounds or who's getting rich from it. Do you really understand how that stock makes money? Do you know what that real estate syndicate is holding? Do you know who controls your money? If the answer is not really, you're walking into a dark room with a blindfold. Clarity is your only shield. Confusion is where wealth goes to die. Wall Street and YouTube scammers have one thing in common. They make more from your excitement than from actual performance. Read every contract. Ask, how do you get paid? If they get rich, whether you win or lose, walk away. Index funds and high-quality individual stocks are cheaper, simpler, and more honest than 95% of what's sold to you as smart money. You're not trying to be sexy. You're trying to survive 30 years without panic. Some rough guidance: adjust to your comfort. 50 to 60% in high-quality, dividend-paying, boring companies, ideally ones you'd be proud to own forever. 20 to 30% in broad market index funds or ETFs, low-fee, long-term. 10 to 20% cash or near cash for optionality, emergencies, and peace of mind. Optional, 0 to 10% in asymmetric bets, only if you can afford to lose it. The goal: no single event can wipe you out. Yes, that's what I call it. Clickbait thumbnails, hot stock tips. Why this crypto will 10 times. It's mental junk food, and it's poisoning your decisions. You're not trying to win Twitter finance. You're trying to retire in peace, sleep at night, and not be a burden on your kids. Delete the apps. Unsubscribe from the hype. Replace it with books, letters from real investors, and actual study. Ask yourself, what happens to this in a recession? If this drops 40%, what do I do? If I die tomorrow, can my spouse manage this? Your plan should survive panic, illness, inflation, war, stupidity, and death. If it only works in good times, it doesn't work. Set up automatic contributions. Reinvest dividends. Check your portfolio quarterly, not daily. The more you do nothing, the better your odds. Most wealth is destroyed by tinkering and reacting. Build a system you trust, then walk away and live your life. Just because you make a lot doesn't mean you keep a lot. Don't let a high salary or business income trick you into thinking you can afford to be reckless with your portfolio. Wealth is what stays when the income stops. Protect it like your life depends on it, because one day it will. You'll be pitched everything under the sun once people find out you have money, old friends. Real estate bros, cousins with a plan. Tech startups, online trading platforms, passive income fantasies. If it doesn't pass your filter, say no. If you feel pressured, say no. If it sounds too good, you already know the answer. Boring no's are what fund extraordinary peace. Yes, write it down one page. Simple rules. I only invest in things I understand. I rebalance once a year. I don't touch principal for 5 years minimum. If I can't explain it to my spouse, I don't buy it. Now here's the key. Follow it even when it's hard, especially when it's hard. That's how you stop making emotional decisions and start acting like a capital allocator, not a gambler. You don't need complexity. You don't need to chase. You need a boring checklist that protects you from yourself. That's the difference between someone who retires in quiet wealth and someone who has to start over when they should be winding down. Here's what people get wrong. Here's what surviving 30-plus years looks like. Here's the difference between noise and wisdom. Let's start with a hard truth. Most people don't actually want to build wealth. They want to feel excited about money. And that's the first domino to fall. They mistake emotional stimulation for smart investing. They confuse hope with strategy. They'd rather feel alive chasing a 5x crypto bet than bored holding Johnson & Johnson for 25 years. But I'll tell you what, boredom builds fortunes. Excitement empties accounts. I've seen it again and again. People who crave drama in their finances eventually get it, in the form of panic, regret, and forced liquidation. So if you feel like your plan is too slow, good. That means it's probably working. What surviving 30 years actually looks like, it's not being a genius. It's not picking all the right stocks. It's not finding some secret ETF no one knows about. It's this. You didn't sell in 2008. You ignored the hype in 2021. You stayed calm during COVID. You let dividends reinvest. You lived below your means. You didn't get cocky. You didn't get desperate. You didn't quit. That's it. That's the strategy that built generational wealth for the people who didn't implode during the flashy decades. They weren't smarter. They were less stupid for longer. That's all it takes. Why $250,000 done right can outperform $1 million done wrong. Let me give you a simple comparison. Imagine two people. Person A starts with $250,000, holds a portfolio of 10 to 12 high-quality businesses, reinvests dividends, avoids panic, never makes a big move, just lets it run at approximately 7% annualized. Person B starts with $1 million, makes one big mistake every 4 years, loses 30 to 40% in a speculative trade, keeps trying to get it back, slowly bleeds through overconfidence and poor timing. Who ends up wealthier after 20 years? It's not even close. The consistent tortoise laps the emotional hare every single time, because wealth isn't about what you start with. It's about how little damage you take on the way. The market is a battlefield. The one who bleeds the least wins. The gambler's fallacy of, I have to do something. Let me tell you about John. Mid-50s, made decent money, had about $300,000 saved, but he couldn't sit still. He needed to make it grow faster. So he bought a course on options, took a few wins, felt smart, leveraged up, lost 70% of his account in one panic month, called me afterwards, devastated, said, I just wanted to make up for lost time. I told him something cold but true. You made it worse. You turned slow and safe into fast and unrecoverable. He didn't need brilliance. He needed a brake pedal. He needed to believe that boring wasn't bad. But by the time he learned that, it cost him the very thing he was trying to protect. Don't let that be you. What if I only have $100,000 or $50,000? Same rules apply. The only difference is time horizon and behavior become even more critical. You're not allowed to make dumb mistakes. You don't have the buffer. But the good news? You also don't need brilliance. Just own fewer things. Understand them better, watch them less, and let your savings rate plus discipline do what speculation never will. The 3 behaviors that secretly make you wealthy. Let's boil it down. 1. Patience. Not the passive kind. The active, stubborn, intentional patience that lets winners compound while the world chases noise. 2. Restraint. Not buying that house you can't afford, not joining that real estate mastermind, not switching strategies every year, not doing things as the edge no one brags about, but it's the one that works. 3, clarity, knowing your plan, knowing why it works, trusting it through drawdowns. People panic when they forget their own philosophy. You master those 3, you could start with $10,000 and outperform someone who inherited $1 million. You want to know what real wealth sounds like? Silence. It's not loud. It's not flashy. It's not checking your phone every hour. It's knowing you're going to be fine. It's watching the chaos without getting pulled in. It's sitting on a beach or reading a book while everyone else is refreshing charts. The market is filled with noise, but wealth is quiet. You want $250,000 to beat $1 million? Make it silent. Make it boring. Make it last. You don't need to be brilliant. You don't need to catch every wave. You don't need to impress anyone. You don't even need to feel like an investor. You just need to avoid stupidity consistently for a long time. That's it. That's the edge no one markets because it's not sexy. It doesn't sell books or get you followers, but it does build the kind of quiet, resilient, untouchable wealth that actually matters. Not the kind that looks good in a screenshot. The kind that lets you breathe. The kind that lets you say no. The kind that still works when the world doesn't. So let me say it one last time. $250,000 done right will beat $1 million done wrong every single time. Not because of luck, not because of timing, but because of behavior. Because compounding isn't a trick. It's a reward for not interrupting what already works. You want to feel rich? Go gamble. You want to be rich? Get boring, stay consistent, and don't blow up. That's the real game. Everything else is noise. In the end, the winners aren't the loudest. They're the ones still standing.